Morning, Aaron. Welcome back to Morning Kappa at 8. Joseph here. So looking at the Hang Seng index, right? It's still um extend the sideways consolidation as of what we see yesterday, right? The upside movement was rejected by the 20 and 50 days moving average. So for the past 2 weeks, Hang Seng has been undergoing a consolidations. Nevertheless, a very strong support has established at 25,000 point. So I think that right now we are on the first week of December, right? Things may get clearer, right? Once we move into the third week or even the final week of December. But nevertheless, I still think that um, in the month of December, right, Hang Seng should tends to be a little bit should tends to be more bullish as what we have seen in the past few years seasonality chart, right? So uh, at this juncture, I still keep a bullish bias on the Hang Seng, right? I will uh, buy near the support and sell near the resistance, okay? And looking at the US market, right? Before we move to the US market, just to update a bit on the oil market, right? Yesterday, we do see that the US WTI crude have faced very strong rejections at the 50 days moving average. The commodities have give up the gains that they have made for the past two sessions. Due to the one piece of news that Iraq is going to resume on their oil production side. Overall, you can see that the WTI has been moving steadily downwards below the 50 days moving average and also below the 200 days moving average. So as for the WTI, we kept a bearish bias and a stop loss point set at the recent high, which is the 65 US dollar. So we kept that during the September month, that's where the crude has a false breakout on the 65 resistance, right? And then on after the false breakout, it breaks the support, and then on the in the late October, there was a retest of this 62, and thereafter the crude oil continued to move on a lower low. So this 62 and 65 carry a very important meaning, right? The 62 will be the immediate resistance, and the 65 will be a major resistance for the WTI crude. So in a bearish setup, it's more likely to see a bearish breakout, and support will be weak, and likelihood the WTI may extend corrections toward $55 level. So meanwhile, after talk about the commodities, let's look at the US interest rate trend so far. So this is actually the chart that I get from TradingView, right? Where these are the 5 lines that you actually can get it from a TradingView. Firstly, let me explain. This debit credit basically is the upper limit of the Fed rate, which is 4% right now. And then the green color is the overnight RRP, which is the stock code is this level. So this is the lower limit of the federal rate, right? As you may aware, right, the Fed rate is actually in a range with a lower limit and upper limit. So it's actually moving based on the last meeting, right? It have revised downward to become 3.75 and 4. So these two level is actually a constant level. But what is tradable in the market that's actually moving is actually the SOFR and the blue color, which is the Fed fund effective rate. So these two dynamic line will actually indicate how severe the liquidity among the bank. Using the Malaysian jargon, this SOFR basically is what we see the overnight lending rate between the bank. So when the bank have a liquidity issues, they will actually lend from the Fed, and that's where the rate actually will move up. So somewhere in the I think on the late October, you can see the SOFR have actually moved above and break the roof of the red color, which is the higher than the Fed rate. That's where it caused the market have corrections. And I think last week this green golden color SOFR also actually break past the Fed rate about 4%. That's actually caused a bit of a profit taking in the market as well. But so far yesterday, the SOFR has really came back to the band, and it shows that the money market right now has become more or less stable. Okay, so using this DP credit, which is the higher limit of the Fed rate, right? We can see we can try to compare this against the bond rate of 2 year, 3 months, 10 year, and also the 30 year, right? That's actually show a very stark pictures. Is that before, I think last year, right, you can see that the Fed rate is actually one of the most expensive instruments that actually in the market. Meanwhile, the 3 months and the 10 year and the 2 year all below the Fed rate. That shows that this is where the tightening was happening during the last year, right? And right now, what we do see is that the red color line has been actually moving downwards, and the 3 months bond yield have actually come all the way down as well. So comparisons comparatively with last year, right? The 3 months bond yield was the most expensive one, and right now the 3 months bond yield is actually a cheaper ones. And using the 3.7%, and then you can see the 30-year bond yield, which is at 4.8%. So if you are borrowing a short-term rate right now at a cost of 3.7 and you invest in something that return about 4.8%, you can see that right now here, this is where you have a margins or the spread that's actually widening. That shows that with this three year and also the 2 years that actually coming down, right? Business tends to actually borrow the short term and invest in the long term, right? That shows the market has become more and more healthy. So based on this chart right now here, it shows that everything's looks good right now, and looking at the trend ahead, right, the Fed is going to a likelihood to cut their rate again. If this red color line is going to move downwards, right, it may actually give more liquidity to the market and encourage more business to actually invest for the long term, and that's where the capex we can see more happening in next year, right? So this is actually shows that the market is actually pretty healthy, and I think that even so, even though the S&P is actually trading at a high level right now, right, the bond market is actually very healthy. One thing is that looking at the equities market, we're actually using a discount rate of this 10-year risk-free rate, which is the 10-year. As of yesterday night, 10-year have actually moved up, right? And the equity market have a little bit of a pullback of yesterday. But so far, as long as the bond market is healthy, the money market is healthy, right? The equity market is only about a matter of pricings, right? How much the investor are willing to give on the risk premium or on the market, right? So I think that the near term, there shouldn't be a very big corrections unless there is a very big macro change in the market. Otherwise, the corrections would be a small pullback in the market that we actually can positions to buy when the market have a dip. So based on technical, you can see that weekly resistance is somewhere between 6,006 and 6,7045. So this is the range that I'll be looking at this week. If this week S&P move towards this level, which is support zone, this is where we can actually be more aggressive in buying, right? And when it go up here, resistant, that's where we can actually take profit if you are going for a very short-term swing trades. So overall, I think the market looks healthy at this level from a technical view. So, so these are the stocks that I have actually make it into a different team and sectors that you can actually take a look. And nothing much changed since last results in the October. The only counter or sectors that I have a little bit of concern are actually a crypto story, which involves the Coinbase and MSTR, and these two stocks have been actually moving a downtrend. So instead of putting up in a very big space, I put it in a small little corner here, right? No doubt, these two counters right now is under a very sharp corrections, right? And among the IT or the app, one of the counter that I've been talking so much is APP, right? App loving, right? A counter has been actually moving upwards, and right now, I think the stock is strong. You can actually put this stock in the watch list, study them from a technical angle and also the fundamental, right? And as for the Malaysia market, right, we have corrections as of yesterday. The index have fell below their 50 days moving average, but make a bounce at the 1,006 critical psychological level. So we still keep a bullish bias until the FKRI falls below the 1,006 stop loss point. As for the FCPO, you revert to a correction as of yesterday, right? So the momentum have the bullish momentum have eased, and the FCPO resort to the corrections phase again. So for the FCPO, right, on the upside, resistance remain intact at the 4250, and the 200 days moving average are moving downwards. So for the FCPO, I think the story right now is about the inventory level, right? Market is actually looking at the inventory, which are right now about 2.6 million tons, right? Whether this coming December, which is just tomorrow, 10th of December, whether the November data will be better, that yet to be seen. And also tomorrow, 10th of the December, we're going to have the export data for the first 10 days of the market. And right now, one reason the inventory level is very high is because the production level is high, and secondly, the export number is actually very low. So tomorrow, on the 10th of December, what we are going to look at is actually whether the first 10 days of export, it does improve as we are moving towards the new year, and also next year CNY, and also the next year the Hari Raya, yeah, in the March. So if the importers like India, they start buying, right, that may actually helps to ease off the high inventory level of the FCPO. Otherwise, right, the FCPO may be moving sideways or downwards below the 4250. So we still keep bearish bias on the FCPO with 4250 as our resistance level. So I think I want to take a bit of time to actually talk about one of the counters here, which is the Tenaga. Tenaga have actually experienced a very sharp corrections recently, and interestingly, on last Friday, right, we do see that when the market closed, that's where DBT have actually changed hand at about 1250. So the total volume is about 2.5% of the outstanding shares. And you look at the last 1 week as well, right? In totality, there's about 3.5% of shares have been changed hand at different prices. But at least on the Friday, we learned that 2.5% have actually crossed at 1250. So as long as these sellers they are not selling anymore, right? I think in the short term, right, the Naga would have room for a technical rebound, right? Breaching the 1276, and probably it will move back up to 13 ringgit. So I think that that was a fund manager that are doing their portfolio rebalancing, right? And there's a buyer and the seller. Most important for a counter is that the seller, if they are not going to sell anymore, and after the selling pressure have tapered off, right? Technically the counter should stage a rebound. So this piece of information is actually very important, and basically this is a public information that you can actually find from a trading platform, that you can see the DBT have actually happened at this level of 1250 on Friday, right? And so we'll continue to monitor whether there will be more big lots being traded, and at this level, at this juncture, I do think that 1250 is actually quite meaningful support for the Tenaga. Of course, the next one will be another full number at a 12 ringgit level. Okay. Now, another counter that I do see that stocks actually are moving on a very strong upwards momentum is actually Leonghap, LHI, which they have a break past the 70 cents resistance. So over here, I think we have published one technical note on the Leonghap as well. We set 76 cents as our stop loss point. So based on yesterday price actions, Leong Hub initially they have a selling pressure, but through the midday and also the afternoon, right, Leong Hub managed to close higher. That overall price action, it shows that the bulls have a upper hand than the bears. All right, buyers have actually overpowered the sellers, and 70 cents have once again proved to be a resistance turn support level. So on the upside, Leong Hub will be moving towards 75 and followed by 80 cents. This is actually what I see from a technical picture. Now, if you are interested to learn more, you can look at Wei Xiang reports on Leong Hub, which he has actually published, I think, about 2 weeks ago, somewhere around here on the result note here. And then on, as of one counter that we have talked about last week, right, during the Vanessa, we have actually a seminar with the East Malaysia clients. And the next day, I did mention to you about E&O as well, that this counter actually have a very sharp corrections due to they actually fell out from the Sharia loan. And what happened is that on this is T1, T2, and then on the T3, right? I did mention to you that T3 likely to have a rebound, and true enough, right? When we look back, E&O have a very strong rebound on the third, fourth, fifth, seventh day, right? And right now it's touching the 75 cents of resistance. Right, we also have a technical note on the E&O, right? I think about 2 weeks ago, right? That actually shows that what we have seen on the technical picture is actually correct. And these sharp corrections, once again, I want to share with you this knowledge is that on this day of sharp correction, there is a very big group of sellers, but on the same time, there are also a very big group of buyers. Now, as long as the selling pressure have eased off and the buyers stay in the market, and that's where you can see that E&O have actually continue have a rebound. So based on this counter, we learned that based on technical, what we need to do as a trader or investor is how do we make use of these informations in our trading. And sometimes we may want to actually enhance our returns by using leverage tool such as call warrant. Now, same goes to the Tenaga that we have just discussed just now, right? If that is a strong selling pressure, as long as the selling pressure has a taper off and the buyer stay in the market, right? Likelihood this counter will see a technical rebound. Now, whether it will happen, that's what we need to monitor and to make this piece of information, then you can actually check with your remisier dealers to learn about how to use a leverage tool in your trading. Okay. Right, as for the trading counters this morning, right, trading stocks, firstly, we have JCY International, which are about to break 32 cents and a half. So if a breakout happen, JCY will be climbing towards 35 and followed by 37 and a half. Downside support is at 30 cents. Then on, we have IGB REIT, break past the 2 ringgit 60 cents, heading towards R1 at 2 ringgit 75 cents and R2 2 ringgit 85 cents. Downside support is 2.50 cents. So we have one pending breakout JCY and one breakout stock IGB REIT. Before I pass on to the next speaker, right, I just want to mention that today is the official debut day for the OKIM, which they are going to list in the Bursa main market at the market cap of 920 million. So basically, they have raised their money that 87% they are going to buy the new vessel, right, which that is this CPP tanker, part of their expansion plan. And then some of the proceeds they are going to go for the working capital, and some will go for the listing related expenses. Okay. And as of what we have seen, right, the IPO, the retail offering have been oversubscribed by 11.84 times. And based on the recent some of the data you can actually find from Malaysia Stock Bees or Bursa Malaysia, or even their prospectus, right? This is the thing that usually I'll use the Malaysia Stock Bees as a quick and easy way for me to look at their things. And right now, the OKIM is also a compliant, Sharia compliant counter. And as of the 4th of December, which is last week, they actually delivered profit about 13 million, right? Based on the revenue of 72 million. So over here, what we have read is that the management have mentioned that if not because of the listing expenses, that would have the normalized net profit would have been 62.3 million, right? So that's actually what that have mentioned. Overall, I think this is the overall 1 year number, right? And they also mentioned that they are going to declare an interim dividend, 20 million, that's going to payable in January coming next month. Okay. So this is the counter that are going to debut on the main market today, which with the listing price at 92 cents, and the counter is Sharia compliance. Okay, right. I'll stop here and then I'll pass on to the sessions to Jeffrey. Thank you.
Okay, thanks, Joseph. I just move on to the third quarter results wrap or read-throughs for the telecom sector. Essentially, if you look at the third quarter, the September quarter that's just ended, a couple of good results here coming from Maxis and Time. I think both companies recorded earnings that beat expectations. You're seeing very good, strong, solid cost optimization programs across both stocks. OCK Group is the one that disappointed. Very sluggish contracting revenue still, ringgit strength obviously affecting some of the translated revenues from its tower cores in Cambodia and Vietnam. Axiata, TM, and CelcomDigi, CDB earnings were basically in line. Just want to point out that there were a couple of one-off items across the three companies, so I've actually adjusted the core earnings to account for the one-offs. On dividends, Time actually surprised. A special interim of 21.64 cents declared. Those of you that have been following Time.com would know that they have a string of special payouts before. So this quarter is another quarter where they've decided to release more cash to be distributed back to shareholders. Now, management did say that they will be looking to optimize their balance sheet further over the next 12 to 24 months. So to expect special divs to be a bit of a regular feature for Time as we move into 2026. Now, post the results, we've made just one single adjustment in terms of earnings. That's to Maxis. We've raised 25 to 27 core earnings by between 10 to 15%. We've not made any adjustments to OSK's earnings at this point, despite the numbers underwhelming both the market and the market as well as our expectations. Really, it's just the first quarter of the financial 26 year, so I do expect earnings to ramp up over the next couple of quarters. They've seen the expanding order book. Order books at 360 million as of end November. And this is basically a quite a big number post the pandemic years, where they've now actually seen this sort of order book. Aggregate sector core earnings, if you add up the fixed telcos and the big two mobile network operators, it basically grew 7% Q on Q. Fixed line earnings were a lot more stronger, 21% Q on Q up. This basically more than offset weaker mobile earnings, which was down about 2.2%. If you look at overall industry revenues, it's still pretty tepid. It's up just over 1% on a year-on-year basis. Now, industry EBITDA, still holding on pretty well. It's been fairly flat. To be exact, it's actually down a very marginal 0.5% year on year. Really, I think the narrative, of the telcos have been, cost optimization. So across Maxis, CelcomDigi, TM, and even Time, I think they've done quite well to actually manage the cost. Subscriber acquisition cost, marketing, network cost. It's all been managed pretty well. So we're seeing the margins and the EBITDA numbers, relatively, holding up pretty well. Of the two mobile operators, Maxis continues to see the revenue and EBITDA share improved. It's been up for the last 2 or so quarters already. The number in terms of revenue is actually at 43.1%, 45.1% in terms of EBITDA. Obviously, that's coming at expense of the bigger competitor, CelcomDigi, who has lost a bit of share, on a quarter-on-quarter basis. This quarter, Maxis has also raised its EBIT guidance, in tandem to the strong 9 months numbers. They're actually raising it to mid-single digit from flat to low single digit. They flagged additional scope still for cost optimization. So, the numbers are looking fairly good at this point. It should basically close, fourth quarter on a high note, and we expect, numbers to be roughly in line with our full year forecast. Now, TM has basically opted to remove its headline EBIT guidance. The previous guidance was for a flat, EBIT for FY25. They're now removing it purely because of an additional VSS charge that's going to take place in the December quarter. They're currently evaluating quite a number. I was made to understand that there was a significant number of applications for VSS from staff. So they're evaluating that VSS, proposals, and it should basically be booked in terms of the fourth quarter numbers that will be announced, in February next year. Time basically said that, if you look at the balance sheet net cash position, I think it's the only telco with a net cash position now, 660 million, the number as of third quarter. So very underlevered balance sheet. Obviously, there's room for them to declare more dividends. This is their intention over the next 12 to 24 months. TM obviously has a lot more room as well in terms of declaring stronger dividends. If you look at their dividend payout policy, it's 40 to 60% of headline PATAMI. It's way back in 2018, where this DPR was instituted. So I think there is a likelihood that management will basically revise the DPR, come the release of the fourth quarter numbers sometime in February of next year. So we see that being a high likelihood, and obviously, with where the net debt EBITDA is, all-time low of 0.5, we're not ruling out a stronger dividend to be declared in terms of the fourth quarter as well. I think if you look at the MNOs in itself, Maxis, CelcomDigi, YTL, these are basically the 5G access seekers. They are basically paying Digital National Berhad, which is the government-owned entity, wholesaling the 5G access to them. This is something that has been a sore point for the telcos for quite a while now. And just about a week and a half ago, the MOF has basically issued a notice to the three telcos, basically telling them that they will be exercising the put option. Basically, they are reselling their stake in DNB, 41.7% that's owned by MOF, back to the three MNOs, Maxis, CDB, and YTL. The three telcos will basically have a combined percent wholly owned DNB by the time by end of January of next year, when the whole put option exercise is completed. So each one of them will have a equal 33.3% stake in DNB. So basically a closure in terms of the DNB shareholding saga here. But really, DNB is suffering from massive losses as of FY25. If you look at the headline PAT, or rather a NAT, it's a massive net loss for 1.2 billion. Really, that's coming from a combination of very high financing charges, loans that have been extended to them previously for the rollout of 5G. Network costs as well as staff costs continues to be high. So I think it's imperative for the three telcos, to, now that they're a wholly owned unit within the three telcos, I think the telcos would be, able to exercise more scrutiny in terms of the cost. They will basically look to revamp or restructure some of the cost elements, particularly that of the staffing as well as network costs, to basically reduce the losses for DNB. I think another sore point is really the close to 5 billion in terms of debt that DNB has accumulated over the last couple of years. Some of these are government guaranteed debt, which will need to be restructured as well. So overall, no change there in terms of our neutral sector call. We still have, TM at Axiata Group. These are the two top picks for the sector. Relatively speaking, we're still, a little bit more upbeat in terms of the fixed business relative to the mobile business. I think the fixed line players are seeing a bit of structural drivers. These are the sort of drivers that will continue to drive earnings over the next couple of years, i.e., the wholesale business, data centers, which is, of course, something that's still well talked about, and the price business, which is something that the telcos are basically looking to focus more on from here. Okay, I'll stop here for now. That's all from me. We'll hear again. We'll speak again tomorrow morning.